Good afternoon. My name is Victoria Flores Najas, and I'm a junior at Claremont McKenna College studying economics. I had the pleasure of meeting Mr. Weinberg in May this summer during the Robert Day Scholars Networking Trip for Finance in New York. Now I'm really excited to have him here at the Athenaeum and at CMC to give us this talk. Autonomous Learning Investment Strategies, or ALICE, describes the emerging third wave of investment managers that is following on the first and second waves of fundamental discretionary and quantitative investing, respectively. Just as countercultural movements have upended established ways of doing things, Michael Weinberg, Chief Investment Officer and Senior Manager of MOV37 and Protégé Partners, believes ALICE managers will as well. Michael Weinberg has 25 years of experience investing directly at the security level and indirectly as an asset allocator in traditional and alternative assets. He is the Chief Investment Officer and Senior Managing Director of MOV37 Protégé Partners, and his portfolio management experience includes Source Fund Management, Credit Suisse First Boston, and Financial Risk Management. Previously, he was a research analyst at Dean Witter, currently Morgan Stanley. Weinberg is a board member of AIMA on the Management Advisory Council for the Michael Price Student Investment Fund, former chair of value investing at CFA New York, where he was received multiple awards, and a member of the Economic Club of New York. He is a published author, has been interviewed by top financial newspapers, and is often a keynote speaker at conferences and universities. Weinberg received an MBA from Columbia Business School, where he's now an adjunct professor of finance and economics, and a BS in economics from New York University. I'd like to remind you that no recording or photography is permitted during this talk. Please silence your cell phones and join me in welcoming Michael Oliver Weinberg. Thank you very much.
Thank you. Great, thank you. Well, it's an honor to be here at Claremont. Thanks for including me in this fabulous lecture series that you do at the Athenaeum. So today I'll discuss autonomous learning investment strategies, or ALICE, what we call the next investment process paradigm, or the third wave. There is a lot of material here for 35 minutes, so apologies in advance. So first of all, what is it? It's the confluence of 5 factors, and the 5 factors are: 1, growth in structures of data; 2, data science; 3, machine learning; 4, low-cost, on-demand, scalable computing, so that's cloud computing; and 5, playing too close to the information edge is a risk. We'll drill down into each of these 5 factors momentarily, but you know, an analog we like to use is Uber or Lyft, which I've been taking around over the last day or two, for example. Uber or Lyft were very disruptive to the taxi and limousine industry. Taxi and limousine prices are down in New York City, for example, 90% because of Uber and Lyft. And our view is ALICE will have a similarly disruptive impact on investment management. Because for Uber or Lyft, it was a confluence of factors as well. You needed mobile phones, you needed cellular or Wi-Fi technology, and you needed GPS. And you put those 3 together, and it was very disruptive. And our view is you put this together, the data science, the machine learning, the low-cost computing, and the playing too close to the edge, and you get this concept of ALICE. So, data. Here we have quadrants of data. The top left, the light blue, is typical structured financial data. Bloomberg, Reuters, FactSet, Capital IQ. That's what both discretionary managers, so the first wave of investors, we'll call discretionary the first wave. The second wave we'll say are traditional quant funds. And the third wave we're saying are ALICE. So the top left there, that was used by the first and second waves. Our view is the third wave, or ALICE managers, are using these other 3 quadrants, the unstructured and non-financial data, so advertising data, municipal data, shipping data, Twitter, cellular data, satellite imagery, credit cards, purchase data, SEC data, news data, all of this unstructured non-financial data. You could think of it as this data not really being readily available in Excel spreadsheets and categorized by company. So data growth. So by show of hands, how many of you knew that data is growing at Moore's law exponentially? Oh, good amount, great. And And so you can see it here. So this is measured in zettabytes, and you see here in 2006 there was theoretically less than 1 zettabyte of information. And now here we are, fast forward to today in 2018, and we're approaching 20 zettabytes. And for context, a zettabyte is more than 4 million times the size of the entire US Library of Congress. And if you look, the structured data in the light blue, that was that top left quadrant on the prior slide, is growing, but it's relatively mature, at least compared to the unstructured data, which is growing exponentially. And this is where we see the excess returns coming from in investing in finance from these Alice managers, from the unstructured data. So the number of alternative data providers has exploded, which we believe will drive down costs. So again, if you look here, at 20 years ago, there were less than 20 alternative data providers. So you can think of these as aggregators who aggregate alternative data. And if you were running a hedge fund or an investment management firm, you could go to one of these and say, I'd like to acquire different data sources. And now you see that's gone over the last 20 years from 20 to 200, so up 10x. You can see it's grown exponentially as well, just as data has grown exponentially. This is only aggregators. So this is not the multitude of sources of all that unstructured and structured financial and non-financial data. These are just aggregators. So, how to interpret the data? Well, you have these quadrants of data, right? This is easy, the financial structured data. That's the data that, you can get it on Bloomberg. I mentioned Capital IQ, FactSet, Reuters, wherever. It's pretty much in Excel spreadsheets, categorized, labeled by company and industry. Very easy to use if you're a discretionary first wave investor or second wave investor, traditional quant investor. However, these three quadrants, the unstructured and non-financial data, that you need data science for. You need to parse it, classify it, normalize it, organize it, categorize it. A good example is, let's say the president puts out a tweet on infrastructure spending. That could have material impact on securities. Infrastructure stocks, for example, aggregate or concrete providers or equipment rental companies. The list goes on and on. But the question is, which ones? And is the effect positive or negative? In other words, that's unstructured, we could call it unstructured financial data. And that would need to be, you would need a data scientist to take that Twitter and make it valuable from an investment perspective. And if you look at a lot of this data, like public filing data or government filing data, again, you would need a data scientist to take this unstructured and or non-financial data and make it valuable from an investment perspective. So, what is machine learning? Well, Arthur Samuel, who's widely credited as one of the inventors of machine learning, in 1959 stated that it's the field of study that gives computers the ability to learn without being explicitly programmed. So that's about, 60 years ago. In traditional programming, so you could think of this, traditional programming, as the second wave of investing, the quant firms, traditional quant firms, academic finance, and basically they're hypothesis-driven, where the programmers develop models based on which they code rule-based algorithms, and then they feed data to produce the desired outcome. So you see the inputs, the programmer, the model, the computer, and then the outputs. And machine learning, or what we call autonomous learning, is data-driven. Data is provided to a learning algorithm for which models are developed. They can be used to solve the problem task. I would say, one of the primary differences is this traditional programming is more static, and this is more dynamic machine learning. It's constantly learning from the data. It's constantly updating itself. We'll talk a little bit more about. I'll mention some machine learning techniques in a moment on another slide. But we'll just keep this very high level in light of the 35-minute time constraint. Does anyone know Jeremy Howard, by show of hands, in this room? Anyone? Okay. Jeremy Howard is an AI expert, Silicon Valley visionary. He gave a TED Talk, which is really what inspired us on this concept of Alice 2-3 years ago. And my partner Jeff, the founder of Protégé and MOV37, was at that TED Talk with him. And basically he said computers are on the cusp of outperforming humans in a multitude of tasks. And he's founded multiple AI companies. He's really a fascinating guy. And what happened was simultaneous with this speech a few years ago, we started to get some investment managers coming to us with funds that were Alice effectively, that were using machine learning and alternative data. And they were basically systematizing what people like myself did at Soros and other firms, and doing it much faster, cheaper, more efficiently. And that's our view, that these Alice managers can invest faster, cheaper, and more efficiently, and therefore will be very disruptive to the status quo, the first wave, the discretionary managers, and the second wave, the traditional quantitative managers. So, is the investment game too complicated? Well, we say it's been said before. It took 38 years for a computer to become the world master at checkers, 12 years at chess, and only 6 years at Go. But the remarkable thing about Go, and I was at dinner with some of the people in this room last night who were familiar with this. How many of you are familiar with Go and AlphaGo and all that? Okay, great, most of you, great. So the remarkable thing about Go, though, is, first of all, so for example, we have a quote here, Dr. Piet Hut from Princeton Institute for Advanced Studies, and in 1997, so again, about 20 years ago, he thought it would be 100 years before a computer could beat humans at Go. Because in Go, there are 10 to the 700 permutations, more than there are atoms in the universe. And then in only 6 years, Google's DeepMind created AlphaGo in London from the University College of London UCL team, and they did it in 6 years. And here, you can see, for example, checkers and chess, when the computers beat, it was really traditional programming, hypothesis-driven. Watson did it with brute force. And you can see there were only 10 to the 20th permutations in checkers, 10 to the 120 in chess, and then 10 to the 700 in Go. And this was truly done and with machine learning. And in the first version of Go, AlphaGo, what they did was they filmed people playing Go, and they showed the computer people playing Go, and the computer effectively learned from people playing Go. In the second version that's not on this chart, subsequently, over the last year or so, Google came up with an even more impressive version where all they did was they did not show the computer people playing Go, they just fed the computer the rules of Go. And the computer played itself randomly millions of times, and the computer learned how to play, and in no time the computer was the world's best Go player. And then they actually were able to apply that to chess, and in like 4 hours it became the world's best chess player. Truly incredible. If you're not familiar with these, I'd encourage you to look at them. So, and then it continues. So there's checkers, there's chess, there's Go, poker. So when my partner Jeff, the founder of MOV37, he went to Harvard Business School. On the first day, they taught him to make decisions under conditions of uncertainty with incomplete information. And in poker, how many of you are familiar with Texas Hold'em poker? Everyone, great. So there are hidden cards and bluffing, right? Well, those are big deals. And in 2017, Carnegie Mellon and the University of Alberta both built AI systems, or systems with AI and machine learning, to beat humans at poker. And so we joke now, computers can prevaricate better than humans. I mean, it's quite shocking and scary. And again, there were hidden cards, right? In the prior 3 games, all the pieces are on the board. Both players see all pieces. In poker, there are 2 hidden cards, right? And that's a much more complex problem. So, why do we say this isn't a false dawn? Because machine learning's been around for 60 years, and it's had what people refer to as nuclear winters, where it's been overhyped, overpromised, and underdelivered. And why was that? Well, because historically, computing power was very expensive. We'll have a slide on that momentarily. And there wasn't enough data. And data science didn't really exist. And again, that's why, if you remember the second page of this presentation, there was this confluence of 5 factors. Now it's all come together and coalesced. So here, this is an ImageNet visual recognition challenge. So it's computers recognizing images, tables, chairs, people, stage, lights, it's carpet. And for some years now, computers have surpassed humans at it. So again, if you think back a few slides to the Jeremy Howard slide, computers are doing things that people did. Computers are doing things better than people now in a multitude of things. But we're saying it's man or woman, plus machine dominates man only or woman only. And this is, for example, a slide with the top chess matches, and where it was man and machine or woman and machine, cyborg type thing, dominates either the human or the machine only. So, again, we were discussing at dinner last night and in the class last night, there are a lot of different types of machine learning. There's supervised, unsupervised, reinforcement learning, gaming. What we've found, so I guess it might be worth mentioning, what we've done is we've gone around the world and we've met with more than 200 of these Alice managers creating these autonomous learning investment strategies. So investment managers using machine learning and alternative data. And what we found is there's no one best process or panacea or technique. They're all potentially interesting. It depends what problem you're trying to, what problem a manager is trying to solve. Managers can invest in different securities over different time frames, long, short, both. But there are many different techniques. So in the confluence of factors on the second page I mentioned, one of them was record low processing and storage costs. And here you can see it. So $1 million of 1980 computing cost 4 cents today. So that's why, like, if you were trying to use machine learning in 1980, there were machine learning concepts, techniques, algorithms, but it was very difficult because it was very expensive, and you needed to have an immense budget to do it, and you may or may not, again, have had sufficient data, and data science was nascent. Now that's all changed because you have the data, you have the record low processing and storage costs, and you have the data science. So you put it together, and it's very powerful. For example, I know a portfolio manager who, he's like, I tried to do neural nets or deep learning a few years ago even, and he's like, it was clunky, it took a long time, it was expensive, it was frustrating, and I said to that person, try it again now, it's completely different because of this, because of the advancements in the algorithms, the diminished cost, the data science. This is another slide. It's similar. It shows the competitors in the cloud, primary competitors, Amazon, Microsoft, Google, IBM, and that their pricing just continues to come down exponentially. So this continues to get cheaper by the day. I think we can skip that. So what we're saying here is you take the man or woman, you take the machine, the data science, the quadrants of data, the data science, the quadrants of data, and the machine learning, you put it all together, and you have this concept of autonomous learning investment strategies. And the reason we have this logo in the middle is it's the intersection of the Venn diagram, where all this comes together. And we believe it's very powerful and will be very disruptive. So, by show of hands, are people familiar with high-frequency trading in this room? Yeah, many. Great, perfect. So what it's not is HFT, or high-frequency trading. This is not a co-location game where you need to have your servers at the exchange and you're competing for nanoseconds in terms of trying to either front-run or be faster execution. This is more like fundamental or technical investing over the medium or long term. We'll define as days, weeks, months, even a year. So the investment period of these securities is days, weeks, months, even a year. And it's very much like what I did at Soros or other, what, for example, I was in your investment class last night, what you're trying to do in the investment class. It's very similar conceptually. Could also be technical or could be a blend. But it's not a latency game. It's not a high-frequency game. There are HFT or high-frequency managers using Alice, but we don't think that's where the opportunity is for regulatory and other competitive reasons. So, the third wave, the Darwinian evolution of the repeatable process. So David Swenson of Yale wrote a book, Pioneering Portfolio Management, and he talked about a repeatable process. And Our view is the first wave, so you can think of this as the three waves. First wave, discretionary, I keep talking about. Second wave, traditional quant. Third wave, Alice. And the first wave were top-tier MBAs and finance professionals. Like myself, I have a Columbia MBA, as mentioned, and I teach at Columbia Business School. And I think business school's great, and I think Columbia and Harvard are great, and Claremont's great. But if you look at the future of Alice managers, our view is it's not those people. It's not the top-tier MBAs. And then here, the second wave were the quants, the PhDs. These were PhDs. These are traditional academic finance. And these are like PhDs in finance and economics. On the third wave, the Alice managers, they're different people, and I'm going to get to exactly who they are in a minute. They're PhDs, but not in economics and finance. And again, there's a lot of text on here, but I don't, in light of the limited time, I think we'll just continue. So if you'll recall, I mentioned that there was a fifth factor in the confluence of factors on the second page, and it was the information edges changed. In 2000, I remember when Reg FD was passed, Regulation Fair Disclosure. The companies had to disclose the same information to all market participants at the same time. In 2013, the SEC started really enforcing insider trading. They fined a well-known large portfolio manager, $1.8 billion, and they put an investment analyst or PM in prison for 9 years for insider trading. So if you were in the first wave, these discretionary managers, so in this discretionary wave, where you're trying to get better information from company management, it was much easier 20 years ago when you could go to a CEO or a president or CFO and discuss the company and how it was doing. Like, let's say IBM, how are your orders? How are your cancellations? How is your new business? Now, if IBM wants to disclose that, it has to disclose that to all market participants at the same time. So if you were trying to get your information edge to be a better discretionary investor, that edge has become much more difficult to get through speaking to company management, at least about their own company. So now we joke with the monopoly guys, you have three choices. Back off the edge, so don't get the information, because if you do, you risk paying a fine or going to jail. And presumably, you're ethical and you don't want to pay a fine or go to jail, so if you back off the edge and you're in the first wave, up there, where does that leave you? It leaves you in a much more precarious, difficult position. And that lends itself to, we would say, this and this, particularly this, where you're using anonymized information. You're using anonymized data that's often public and is not material non-public information. When I say often public, I mean people can find data sources that are not necessarily in the public domain. It doesn't mean that they're material non-public information. The genealogy of existing quant managers, it seems as though this is a fairly financial savvy room, probably a selection bias there in terms of choosing to come here, which is good. These are some of the top quant firms. It's just a family tree or a genealogy. And the point is, a lot of these firms have done very well, and then and these are mostly traditional second wave quantitative finance firms. There are a couple of more Alice funds on here. They generally do very well, and then they close their best funds and open newer funds that are often not quite as good as the original funds. So where's the talent? I mentioned on a couple of slides ago that it's no longer the MBAs or the PhDs in finance and economics. So Jim Simons of Renaissance, who is a visionary and probably one of the best investors in the world, says, I have one guy who has a PhD in finance. We don't hire people from business schools. We don't hire people from Wall Street. We hire people who've done good science. And where we're seeing the talent is exactly what Jim said years ago. So from some of these top existing quant managers that were on the prior page, the academic finance, and there are some PhDs coming from there, from industry, FANG, Facebook, Apple, Amazon, Netflix, Google, and the universities. This is a primary source. Top universities in all over the world, the US, Europe, Asia, all over the world. We don't think the next generation of Alice managers or investment managers will be MBAs. Again, I teach at Columbia. I think it's great. But in terms of investing, what we're seeing is these Alice managers creating funds where they're PhDs, like from these places, not MBAs, they're PhDs, and basically they have, for example, one of them has virtual analysts and virtual traders and virtual portfolio managers. So those are roles that were formerly held by MBAs. You would get hired as an analyst, PM, or trader. Well, the PhD has some programmers and developers, and they created a system with virtual portfolio managers, traders, and risk managers. We have another manager, for example, that we know, where he created 3,000 agents or bots, and each agent or bot trades a single security. So again, like that's a job that might have been done by people trading securities and is now done by a PhD who developed a system with synthetic traders. So our view is that AI will have a dramatic impact on the employment landscape, and quite frankly, if you're going to be an MBA, then you're going to need to know coding, and again, this applies to I think many of you in this room. If you're interested in a career in finance, you're going to want to know not only the finance and investing, but coding and machine learning and data science. That package will be integral, because if you have that combination, you can do it faster, cheaper, more efficiently, and systematize and automate what people like myself did discretionarily. So, pivotal moves of man versus machine. Why do we call it MOV37? Coincidentally, it was the 37th move in one of the games that Kasparov resigned against Deep Blue, and in AlphaGo, Lee Settle was flummoxed on the 37th move. It was the move, for those of you that've seen it, there's a great documentary on Netflix. It was the move where, the thought was it was beyond the current human understanding of the game. Everyone thought on this 37th move that the computer had made a mistake, and actually it turned out the computer, it was brilliant. It was almost creative. It was a move not seen in 2,500 years of Go playing. So move, MOV, does anyone know assembly language in here? Anyone? So move means replace the old with the new, right, effectively. So we're saying on the 37th move, the old paradigm of man beating machine was replaced. So that's why we call it MOV37. That we can skip. This is our team and advisory board. So I think we have some time for questions. Thank you. Thank you.
Hi, I was wondering, with the rise of algorithmic traders, or virtual traders as you call them, doesn't that open up funds to flash crashes and sort of, the risk of all the algorithms fighting each other in the black box and ending up, liquidating at a position way lower than you wanted to?
Yeah, that's a good question. So look, so first of all, regarding this concept of Alice, I would say we're in the first inning, to use a baseball analog. It's a 9-inning game. We're in the first inning. There's very little assets globally being run in this Alice strategy at the moment. We're really early. At some point, I think some years down the road, when it becomes machine versus machine entirely, that could be more of an issue. But I think we're some ways from that. And don't forget, again, the second wave, what we refer to as traditional quantitative trading, has been around for some years. And with that, too, you could have said it's machine versus machine. And, occasionally there's a flash crash or something here or there, but, nothing that's been so detrimental to the system. And again, even if you look back to 1987, one of the crashes, there was an element of quantitative programs that fed that, and that was, 30 years ago now. So I think, the concept's not new. I don't think that's a particular threat at this point. Other questions? I think there's one there.
Hi, I'm a computer science and economics. Well, I'm an economics major, and I'm figuring out where the computer science lies. And I guess it's kind of a personal or practical question, but with Alice trading, do you see the usefulness of computer science as the hard skills of being able to program, or more like the theoretical side of the computer science?
Yeah, it's a good question. So it's really like the ideal is someone has a really good understanding and passion for investing, is good with the computer science, including the data science and the machine learning. And then when you combine that, it can be very powerful in our view. We've seen all permutations of it, like very good computer scientists who don't understand investing, people who understand investing aren't so good at the computer science. We've seen all permutations. It's really, and it is unique to have this confluence of factors where they have it all together. Because, like I mentioned, we've met with over 200 of these managers, and only, most of them are not investable for various reasons, either falling short in one or multiple of these categories. There is only a small minority that is really robust in all of the categories. It's very difficult. For those of you that were in the lecture last night at the investment class, we talk about why it's much harder to program computers for investing, use machine learning for investing than it is to recommend books or movies on Amazon or Netflix, or use machine learning for many of these other things. And we've seen for example, we've seen multiple Silicon Valley people, including people who've invented Siri, try to do this and use Alice or use machine learning to beat the markets. And after many years and a lot of investment, unsuccessfully give up, including a high-profile one just within the last few weeks. So it's more than just throwing money and Silicon Valley PhDs at it. There really has to be a passion and understanding of investing.
Thank you for your talk. My name is Valerie, a senior at CMC. My question is, so your company is a leading figure in the hedge fund investment business, and how would you describe Alice's use in manager selection and also due diligence process? And also, one of my questions is, would you think machines will totally replace the goal of human in making investment or selection decisions, not only hedge fund but also venture capitals and other investment business? And how do you see your goal, yourselves kind of image, maybe 20 years after that? How do you play a role in making decisions when machine will be even more powerful by that time?
That's a great question. So, no, really, that is a great question, because we developed this scorecard to rate Alice managers over the last couple of years. And our first version was more, in our view, subjective. And now we're on 2.0, and our 2.0 is actually using machine learning. And what we're doing is we're objectifying it, and we are parameterizing it, and we're using certain machine learning techniques to categorize, classify, cluster these managers, and then and then effectively rank them. So we are using machine learning to do this, and I think that's pretty unique in the world in terms of using machine learning to rank, evaluate, cluster, analyze managers. In terms of 20 years, that's pretty far out, tough to say. But I do think there will always be a role for humans. It's just the ratio. It's like there will always be a role for humans. It's just the ratio will change in terms of needing less humans and more computer, I think. Because, for example, as I mentioned last night, there's an Alice manager we know where they've done a lot of. There were a lot of indications that I think were unethical and/or seemingly inappropriate, and that's an example where I'm not sure a machine learning algorithm could have picked that up, or how it would have picked those issues up. And that's where you'd want the human supplement to come in and say, I don't care how good the numbers are, even if they're real, I don't trust these people, and they're unethical, and therefore we wouldn't do business with them. So I do think there will still be a human role, just diminished, like in a lot of fields. I do think AI is a threat to employment across blue collar, white collar. Won't just be, the autonomous driver example is easy, right? Replace Uber and Lyft drivers with autonomous vehicles. Have less need for portfolio managers, again, with Alice strategies, with machine learning. I think this is a societal problem we'll have, and I'm hard-pressed to see what the answer to that is. And again, I think it's not just finance and driving. I think it traverses industries, insurance, banking, many white-collar and blue-collar professions. Other questions?
Hi, my name is Edgar Warnholtz. I'm a senior here at CMC studying economics and international relations. And my question for you is, you mentioned ethics a little bit briefly in your last response, and I'm wondering if you are planning on incorporating the ethics of the investment of the funds that you'll be investing in, as in, we have a lot of talk around ESGs or, avoiding sin stocks and so on and so forth. Will that be fed into the machine, or will the machine be kind of making trades that are secondary or derivatives of these trades, but might have been blocked by a line of code or something along those lines? How do you factor that into your investment strategy?
Sure. So I know, for example, an MIT professor who I spoke with last year is using ESG factors and machine learning to rank companies. A manager that we know well in London uses ESG as one of their as a subset of their factors in determining investment decisions. So that's discretionary. Absolutely, there's no reason you can't have an ESG-driven ALIS fund, or I don't know of any pure play ESG-driven ALIS funds, but I do know ALIS funds that incorporate those elements, and it's certainly easy and viable. It certainly can be done. I think there was a question there.
Thank you, Andrew.
I was just going to ask a little bit more about that alternatives component, like you mentioned with venture capital or private equity.
Oh yeah, sorry.
Funds starting like that, falling within the same principles.
Yeah, so there are. In fact, in LA tomorrow, I'm going to meet with a manager who's a well-known macro manager, and they have an involvement with a fund that's a PE fund that's using AI or ALIS or in some capacity or AI. So I know there are PE funds using it. I'm not sure about VC as much, but I know there are PE. I just haven't met with them yet, quite frankly. And But again, it's becoming, I think, along the lines of your question, it's becoming, again, it's moving very quickly, and it's becoming much more pervasive than we thought. Like, if you'd asked me a year ago, we said it's primarily for equities, futures, and ETFs, because those are liquid, scalable strategies with a lot of data. Now, a fellow Columbia professor that I know is launching an ALIS strategy on illiquid strategies, so that's new. And basically, he's using a machine learning technique that will extrapolate to other illiquid markets. And in credit, for example, again, credit is typically over the counter. It's not an exchange traded market. And we know of a manager who was running $10 billion in investment grade credit. And then there's another manager that we know of using ALIS strategy, a clustering technique for in a $500 million municipal bond portfolio. So whereas we thought it would be sort of years before it expanded beyond equities, futures, ETFs, it's already expanding into credit, and like we're seeing it in private equity. So it will be, I think it'll be quite prevalent. Activism, something we were discussing here last night. An ALIS, a computer is not going to be an activist going after company management, but if I were running an activist strategy, I would certainly use machine learning to source the candidates and the targets. So I think it will really become prevalent everywhere. Professor?
You pick investment managers, right?
Yes.
That's what you do. You pick ALIS managers. Thanks. And I just wanted you to talk a little bit about the dangers of overfitting. And sort of there's two issues here, one of which you touched on last night, which is the fact that anybody can backtest a strategy and have it look good. And you say you need a real track record before you're going to pick a manager. So now I have to ask you the following thing, which is you have to see a real track record, but there's a whole bunch of managers that you don't see because they didn't make it.
Right.
So how do you deal with that selection issue that only the good survive? What
Right.
do you do about that?
Right. Well, that's fair, and that's a good point, and I agree. One of the biggest risks is with machine learning is that it inherently lends itself to overfitting. And so one has to be very careful about that and look at the validation techniques. And but don't forget, so like when I mentioned, like we've met with over 200, we are actually, in other words, we're meeting with the 200, including a lot of the ones with mediocre, lousy track records. So we aren't only meeting with and seeing the best. So we're looking at all of them. That's why I'm saying, like, quite frankly, 80% of them are probably uninvestable. Only 20% are, potentially investable. And then even within that, we're saying we're even constraining it further. But it's a great point, and that is, if not one of the biggest risks with machine learning, that it inherently lends itself to finding patterns that did exist that are very complex, but that will not recur. And I mentioned, I know someone who, anyway, it's a major challenge, and you're right, and it's something we spend a lot of time. We look through how they're validating. There are techniques like cross-validation that some of you may be aware of. We want to make sure that they're not doing that. Yeah.
I think we have time for one more question.
Last one. Anyone? Okay.
Going once.
Twice.
Oh, there we go.
Thank you for your talk. I was curious to go kind of back to the alternative investments. Do you think venture capital and private equity that have to deal with early stage companies are going to be the remaining sliver of the market for which humans are going to be able to outperform computers?
Wait, say it again? Repeat.
For venture capital and
Yeah.
early stage companies,
Yeah.
I know you mentioned when it comes to equity markets, we have large corporations that have been around for a long time. You have a lot of data you can access. And I can see computers being able to use, there's obviously data to use. When it comes to early stage,
Oh, I see what
do you see implications of ALICE strategies in early stage when you're seeking out investments?
I think if I understand the question properly, I think there could be application. Like, for example, like if you could get together a sufficient database, like let's say you have startups, right? Like a Genealogy, right? Like you could say this founder, he formerly started PayPal and eBay and Amazon, so like, and if you could get together enough data, I don't know if you can get enough data for the machine learning to be statistically significant, but conceptually, you could see patterns in the data. You just might not have enough data to use machine learning. But I see it's a fair question. Any other?
Join me in thanking Mr. Weinberg today.
Thank you. Thank you. Thank you.